Hi, this is John Holohan, and I'll be presenting the Proactive Investment Strategy Update for Friday, March 10th. Well, today we're going to touch on all three of the models that we follow to help guide us in the management of portfolios. We're going to start out with the market model, where we spend a fair amount of time in review in these reports. We'll also show you the latest readings, end of January readings for the economic model. And we also have a quarterly update, so finally an update as of the end of the year for our market valuation model. That helps us a little bit more with longer term view of things, but it is an important one that we monitor. It's all three of these models that help us understand if we should be positioning portfolios for wealth accumulation or conversely capital preservation, and maybe in situations like we are today, somewhere in between. But before we dig into our own proprietary models, I just wanted to talk a little bit about some of the news that came out later in the week. You've probably all heard that a lot of the market volatility late this week is due to Silicon Valley Bank and the difficulties that it's been having. And ultimately today it was determined that the bank was going to be closed and reorganized. So their customers are, on the lending side, are tech startups, and then on the deposit side, similar, a lot of people and companies associated with the tech industry. And so a couple of years ago, when they were, let's say, flush with cash, when, the economy was doing well, after all of the money came into the system as a result of the pandemic and the associated shutdowns, they ended up taking a significant portion of that money and investing in long treasury bonds and other instruments. And now with some of the tightening in the economy recently, some depositors have requested some of those funds back, and recently they've had to do some liquidations at substantial losses. And when that news came out, of course, depositors became even more nervous, and now they've actually hit a point where the bank is to be closed and reorganized. So to us, this is one of those unintended consequences of the recent actions of the federal government and the Fed itself as a result to the pandemic. We saw aggressive injections of liquidity into the system. We saw a lot of stimulus from the federal government, not only at the time of the pandemic, but well beyond it. Predictably, that resulted in inflation, which it's the Fed's job to try to control that. And the controls that they have, of course, are interest rates, at least short-term interest rates. So they began hiking aggressively. Ultimately, that translated to the longer end of the yield curve. And so those bond prices came down in a significant way. And so when an institution is forced to sell to meet liquidity requirements, as was Silicon Valley Bank, they got a lot less on the dollar than what they paid. And so this really kind of puts overextended firms in a spotlight. And the question on many people's minds is, will there be contagion from this? Is this just the first of more to come? And we're certainly not going to predict one way or the other, but that is exactly why when there's news events like this, that we go back to our proprietary models, the three models that we'll cover today, and really look to them for insight into what is going on in terms of the market, the economy, and then overall valuations. So let's start our review with our market model review, and of course we begin that with an overview of the dashboard. Here we are at the dashboard, and we can see here the significant signal back here on November 30th when the model signaled shifting from capital preservation mode to wealth accumulation mode. Of course, at that time we also saw a negative reading on our economic model, and so we have proceeded with caution since then. And we're still looking to see if this current global buy signal can really gather some steam to the upside and have a sustained run here. So far it's been somewhat questionable, and we've proceeded very cautiously here. And there is the possibility of this reversing to a global sell signal if this current move down in the market continues. And one of the core indicators here we see actually did degrade a little bit here. The long-term momentum indicator had been positive for 1 month and then shifted to neutral. So let's take a look at this chart. So here you can see, let's just retrace a little bit of recent history. This is coming off of that low in the market in early 2020, right around the time of the shutdowns and the quick injection of liquidity that supported some of this positive market action to a high early last year, probably about the first week in January of 2022 for most of the major indices, and then the bear market action last year. This is the October bottom that we're really trying to monitor and see if this is going to hold, and then the move up, and now finally a ray of hope here, switching to positive at the end of January and now degrading to a neutral reading at the end of February. To give us greater confidence in this trend, we really do need to see some consistent positive readings in this indicator. We've pointed out before, coming from a low level in this very significant momentum calculation down here could signify a significant market bottom has been put in, and that momentum could potentially shift up in a strong way, but we have yet to really see that follow through. So whether this is just a temporary pause, maybe an attempt to consolidate some of this move off of the October low, we're not sure, but this is a little bit of a warning sign for us, this shift back to neutral here. Here's another view of recent market action. This is the MSCI All Country World Index in black here. We use that in our overbought, oversold chart. And I wanted to show this because I could point out here the 2 global sell signals that we received in 2022. One in April, the markets peaked here in January. First global sell signal in April, so that's when the models move defensive, shift to capital preservation mode, and move portfolios to cash and cash equivalents. A little bit of a head fake here with a very short-lived global buy signal that triggered in August, but that quickly faded and was reversed to a global sell signal here in September. And again, our models shifted to cash and cash equivalents and other defensive positions with the goal of preserving wealth and waiting for the next opportunity. And then that opportunity in our market model came again with that November 30th buy signal. And since then you see a little bit of positive action, and now we're trying to monitor to see if this is a step back or if this is just, again, some form of consolidation. But you can see over the last, let's call it 2.25 years, we're globally, as measured by the MSCI All Country World Index, virtually at the same levels that we were trading 2.25 years ago. And along the way, relatively smooth upward action, but then all this volatility that we've experienced in 2022 and now seemingly some additional volatility in 2023. So if this market does continue some downward momentum that had, that kind of started here in early February and accelerated a bit this week on the bank news, it's a possibility that we'll trigger another global sell signal and we'll have another shift to capital preservation mode. We're not going to predict that yet. That's why we have these models, but I just wanted to point out that we are not hesitant to shift to capital preservation mode when we believe it is appropriate. Now let's shift to our second model, and that's the economic model. So what we've got on the screen here is U.S. monthly leading economic indicators updated through the end of January. And you see on the longer of the two, this is the longer lead time indicator in the blue, you see some continued downward momentum for a new low since the post-pandemic peak. And so continued downward momentum. So this is very much of a concern because it tells us that there's a pretty good likelihood of a recession developing in the coming months. On the shorter of the two monthly indicators, you see a little bit of a hookup, so a little bit of an improvement, But until we see something sustained here, I don't think it's anything to put a lot of credibility in at this point. But this model is in conflict with our market model. So if we go back to the global buy signal in the market model back on November 30th of 2022, both of these lines were well below the zero line, so indicating elevated risk of recession. In particular, the longer lead time line was well below the zero line at the global buy signal. So this is conflicting signals here. We've got a positive market model and we've got a clearly negative economic model. And that's why we have proceeded cautiously during this global buy signal, and that's why we've been monitoring the signal so closely. And specific actions that we've taken at the global buy signal and beyond is we only moved partially into model positions. And we held about 50% of the model in market neutral or hedge and inverse type of positions, and things like gold and quality bonds, and some amount of accounts in cash equivalents. So with those conflicting signals, on one hand, the market model tells us that there's an opportunity for wealth building presented that we want to take advantage of. By the same token, the economic model is strongly flashing the possibility of recession coming up could be a matter of months or maybe more than a year, but certainly makes us very cautious here. And if we switch over to the weekly version of the leading economic indicators, we're seeing a little bit of improvement here as well. And we'll just have to see if this, again, is a true reversal or if it's a little bit of a hiccup in the downtrend and the downtrend continues. But you can see if you look at the history, when this indicator does cross below the zero line, more often than not, there is a recession that follows. And of course, the gray shaded areas are the recessionary periods themselves. But you see it nearly every time. Next, I wanted to review our proprietary valuation indicator. It's updated with values through the end of calendar 2022. And I'd like to just give an overview of what we're looking at here. So the blue line on this chart is our proprietary indicator, and we calculate it based on 4 underlying measurements. And its purpose is to help us understand how the market is valued today versus how it was valued at points in the past based on these same 4 underlying measurements. To further get our bearings, the scale is 0 to 100 for our proprietary indicator. And on the far right, we've plotted the 10-year future returns of the S&P 500 from any given point in time. So here's the 0 line, and you'll actually see negative readings, negative 10-year returns, as well as solid positive 10-year returns. The way this works is when you see a low valuation level, like back here in 1982, the future 10-year returns of the market, and since we actually have 10 years of data past 1982, we can see what it actually was. And so you see here a low valuation indicator was correlated with high market returns, in this case over 250% in the S&P 500 in the next 10 years, point to point. Now, this was a period there was a lot of market volatility and negative trending markets into that low reading. There was recession associated with that pullback, and associate that with declining earnings at corporations. And so ultimately, the valuation indicator reached a very low point. Let's contrast that with a point in time when it was a very high reading. And let's just go back to the tech bubble, right around 2000. The reading at that point was up at 80, and you can see the future 10-year returns, 10 years past the point of that reading, are right down here, and you see they were negative. So if we kind of set the stage for how things have evolved in recent years, coming off the market low associated with the bursting of the real estate bubble, you see a very low reading in the valuation indicator. And then as the market advanced over the years, you see a steadily climbing valuation indicator. You see that real sharp pullback associated with the pandemic and all of the policy decisions and things around that. And then you see it advance. And we covered this in the videos around that time about elevated readings here. In fact, the highest in the history of the model. And that was telling us, by historical standards, the market was at very high valuation levels and could be ripe for a pullback. And since then, of course, beginning in January of 2022, as stocks pulled back over last year, this indicator, of course, pulled back with it. Now we've had a little bit of a bump at the end of the last quarter. That could be short-term noise. We're certainly more focused on the general decline from a very, very high level. And so there is certainly the possibility that that momentum continues. With our economic model pointing to recession, that would generally indicate declining earnings per share, which is going to affect the valuations. So therefore, there could be another meaningful leg down in this market. And so this is why we want to very carefully monitor our market model and particularly pay attention to any potential global sell signal. And as I said earlier, we are approaching a point where that signal could trigger. And should that trigger, that would certainly be the warning to shift to capital preservation mode in a very meaningful way to protect portfolio values and possibly even implement some of our bear market strategies to attempt to grow portfolios even in a bear market. The other point worth noting is, even after this decline, this valuation indicator is telling us that's slightly positive returns to expect out of the S&P 500 for the next 10 years. I believe that number is a positive 15% is what this value indicator is forecasting as a 10-year return in the S&P 500. Obviously a paltry number. Certainly another leg down in this indicator would tell us that equity valuations are coming more in line with kind of the median and rather than being at extended levels. The other takeaway we get from this is that while the S&P 500 forecast may be for just very minuscule returns over 10 years, it tells us to be sure to look for opportunities in other areas. We've pointed out in previous updates, opportunities can exist in equities outside the U.S., whether that's in developed countries outside the U.S. or emerging market economies outside the U.S., or perhaps commodity asset classes could perform significantly different than U.S. equities. So to wrap up, as we look at our three proprietary models, the market model, while positive, is pretty close to potentially triggering a global sell signal. That would tell us it's time to shift to capital preservation mode to protect portfolios and await a better opportunity. It tells us that the primary trend in the market is potentially shifting from positive to negative. That is supported by the economic model, which is solidly negative and has been solidly negative for this entire global buy signal. It tells us a recession is a likely occurrence in the coming months. It could be even further out than that, but the indicator and the underlying data points that make that up tell us that a recession is likely. That could be accompanied with another leg down in the market, which leads me to the third model, the market valuation model. The market valuation model reached extremes a year ago, January. It was telling us that equity prices are overvalued, prime for a pullback, and we did see that pullback begin early in 2022. And with that pullback, the market valuation readings have pulled back as well. They certainly could pull back a lot more to hit what might be more reasonable valuations. At the current reading, we see the forecast S&P future returns to be very much minuscule for the next 10 years. So there's certainly a lot arguing in favor of being very, very cautious and being on, let's call it a hair trigger to move to capital preservation mode if we get that global sell signal. If this market does stabilize and the trend to the upside resumes, perhaps all this was one big consolidation, and the market has digested it, and the uptrend may continue. We really don't want to predict either way. We simply want to follow the indicators and act accordingly. Well, that'll do it for this week's update. Thanks for watching.